Good morning, everyone. I hope you had a great weekend. This is Brennan Decima, owner of Decima Wealth Consulting. This morning, I'm going to spend a little bit of time on target date funds. Target date funds have been around since the early 1990s. They had pretty slow adoption out of the gate, but sometime shortly after the tech bubble burst, popularity really took off. And if you look at most employer 401ks, they are the default option of the plan. So billions and billions of dollars are going into target date funds. So very popular. Well, why is that? They are a single fund solution. So they were created for simplicity. So what employers were finding was their employees would go to open enrollment for the 401k. They'd have 20, 30, 40 fund options, and they'd be paralyzed. They didn't know what to choose or how many to choose, and it would just sit in cash. So a huge benefit of the target date fund is its simplicity. It allows people to just say, hey, when do I plan on retire? Let's pick a fund that generally is appropriate for people retiring around that time frame. So it created much more confidence from the investor or the employee to put money into a fund. Because of that, employers started making that a default option. If you don't choose any fund, it just throws you in the target date fund unless you tell it otherwise. So that's great. It forces you to invest, which we know over the long run tends to pay off for people. The second thing is oftentimes employers found that leading up to retirement, the risk that their employees was taking was dramatically higher than what was considered appropriate. And the reason for that is inertia when things are working. So think about driving down the road on the highway. You've got your foot on the gas. There's really not any cars, no cops. It's sunny. You're having a conversation. Everything's going well. And then all of a sudden you look down at the dashboard and realize you're going 20 miles over the speed limit. It doesn't feel like you're driving crazy, but if you were to pass a cop, they'd absolutely say you were going too fast, right? That's sort of how investing has worked in retirement plans. You're dollar cost averaging. You may have a period where there's no market turmoil, and your risk just gets riskier and riskier and riskier. And if you're not rebalancing and reallocating, if all of a sudden there's a crash right before retirement or right after retirement, it can be catastrophic. So target date funds help prevent that. They slowly de-risk over time. And then the third is you are broadly diversified. So employers found that a lot of their employees just threw everything into the S&P 500 or just threw everything into what had the best returns, which could be emerging markets or small cap. And they were just going on this crazy roller coaster. So a target date fund spreads the risk around to bonds, international stocks, US stocks, big companies, little companies. So there are benefits of a target date fund, and they're not a bad way to get employees to retirement if they value simplicity and they know that they're going to be hands off, right? The challenge with target date funds is they're not the best way to get you through retirement. And let me explain why that is. So the first is a single fund solution. Simplicity is not always better, right? So when we craft retirement plans for our clients, we have a cash bucket for surprises. We have a protection bucket to draw from if the market is down. We have income being produced, and then we have a growth bucket for the future. And a target date fund has bits and pieces of those all wrapped into one. So if the market's down and you need money, it doesn't care what your cash flow needs are. It's not building a cash flow plan. So that's limitation number one. Limitation number two is the glide path. So every year, based off the calendar, a target date fund gets a little bit safer. Well, how does it do that? It sells stocks. And in theory, that's not bad unless we're in a bad market, right? So general rule of investment success, buy low, sell high. Well, target date fund, let's say the market tanks, and by mandate, it has to get safer. Well, how does it do that? It sells stocks in a down market, the worst thing that you can do. So the market takes the fund down, it sells stocks, so there's less stocks for the recovery. And if you need to withdraw, it gets even worse. You've now created quicksand. So they're really not efficient for recovery purposes. So the third is they could care less about you, right? They don't care if you're a little bit more aggressive or a little bit more conservative than your neighbor. They don't care if the first few years of retirement you have huge expenses and then they taper off. Or on the other hand, you have a severance, so you have no expenses. So it really doesn't care about your cash flow. And then one of the biggest risks that I see is people holding them not in their retirement plan, holding them in a taxable brokerage account. They absolutely don't care about your tax situations. They may have a lot of short-term capital gains that you're paying taxes on whether you want to or not. So they don't really control the taxation. So the reason that I share this is if you are in a target date fund and you're approaching retirement, just be aware that there's other ways to do it. Simplicity is important. Flexibility is important, but having that growth bucket, that protection bucket, that liquidity bucket separated tends to be a much more savvy move in retirement. And if you need help with this, visit the website, schedule an appointment. If you have questions about your situation, leave them in the comments. And if you find this helpful, please hit subscribe. I hope everyone has a great day.